Hello and welcome. I'm Valerio Baselli, and today I'm joined by Stefan Lee Jen, CEO of Eurizon SLJ Capital. Thanks for being here, Stefan.
Thanks for having me.
So 2020 will be remembered for lots of reasons, most of them not very pleasant, I'm afraid, but I think it will also be remembered as the year when onshore Chinese bond market became the new frontier for global bond investors. According to Morningstar data, European domiciled onshore renminbi bond funds attracted 9.5 billion euros of net inflows last year, with your aggregate bond renminbi fund among the top seller of such category. This is a level never seen before. How do you explain that?
Well, the main reason is because the Chinese bond market is huge. This bond market is now $17.3 trillion in size, having risen from 15 trillion just last year. And all this while, the foreign ownership is only 3% of the total market. So, so 9.5 billion, it's very big in absolute terms, but it's only 0.05% of this market. So we think that there's tremendous scope for growth in the future in capital flows into the Chinese bond market. We think that in the next 5 years, we could see $1 trillion go into this market. And this will average out to be about 10 billion a month, not 10 billion a year. It's just such a big market, the flow, everything will be big.
Right, so looking at the future, do you expect this trend to continue and widen? And what are the main reasons behind that?
I think we can split out the reasons into push and pull factors. So the push factors, they're all related, but they center around the fact that many of the developed countries are facing a pension crisis. In Europe, we understand this very well. In Japan, in the UK, the population is aging. The rate of return on their savings is 0 or negative. So this is a push factor. An aging society that's wealthy in assets needs to look for opportunities to make their savings work for them. There are also pull factors in China, and these pull factors are really compelling, very special. People talk about emerging markets in general, but emerging markets are mainly China now. China dominates the emerging markets. And I think the pull factors include not only the very attractive investment returns, 3 to 3.5% a year, near risk-free, not totally risk-free, but virtually risk-free compared to the other markets in China, but also the superior economic fundamentals in China should help support the currency and contain defaults. So I think it's a combination of push and pull factors. Both are equally powerful.
Right. So the searching for yield is crucial, and that's clear. But what about the other side of the coin? What are the main risks bond investors need to be mindful of when investing in China?
I think it's a good question. I think the answer probably is the usual answer. I think investors need to be aware of default risks, as well as given that most of the investors are not based in China, you need to be aware of currency risks as well. So default risk and currency risk. I think on the first, default rates are very low in China. It's about 1%. Corporate defaults are about 1%. This number is low by international standards, but it's artificially low. We actually think that the trend will be up. This number will rise over time, not just in the long run, but also in the short run. Have you noticed that, by the way, there was a surge in corporate defaults late last year, just as the Chinese economy was accelerating into a recovery. And China was the best performing large economy in the world, and it was experiencing corporate defaults. And I think people should take note of this, and probably it's safe to expect the same thing will happen in other countries as financial support is withdrawn from the economy. We're going to see problems, and we saw that in China. So I think that the Chinese bond market is relatively safe compared to other countries, but it's not totally safe. the best strategy we would advise foreign investors is that in this period of adjustment, the economy is adjusting, corporate bond markets are adjusting, it's better to stay in the safest corner of the Chinese bond market, stay in the very liquid, very huge central government bonds, development bonds, and the largest corporate names, and stay away from smaller names, which may offer a little bit of risk premium, but they're not big enough to compensate for the risk, in my opinion. And on the currency risk, I mean, this is really a very familiar discussion for investors. But I personally think that the economic fundamentals of China are very positive. And also the balance of payments position is very positive. China is exporting to everybody. Like right now, we're just staying at home, working from home, but we don't go to restaurants, but we're ordering from Amazon, and 99% of the stuff that I get are made in China. So no wonder Chinese exports are doing so well, and their economy has not fully recovered. So they're not importing much. So this resulting balance of payment surplus is helping the renminbi for the time being. And in the long run, you get a lot of, you need to consider a lot of economic positives in China as well. So net, I think renminbi exposure that European-based investors may have should be relatively safe also from a currency perspective.
Thank you so much, Stefan, for your time.
Thank you.
For Morningstar, Valerio Baselli. Thanks for watching.